Tesla held that liquidity zone today very, very well, but the bigger picture still remains the same from what we went over yesterday. Short term on the 1 hour, you can see that we are moving back into the market bias, and this is normally going to be where price rejects, and if that happens, that's where the sell-off down to 350 could occur. Realistically, what I think is going to happen instead is that price will break over that $380 level, which would mean that we would move out to the daily chart and look at the market bias. You'll notice here that since breaking below the market bias, price has been rejecting at this level multiple times over the past couple of weeks. And I do believe that if we come back up to test the middle of the market bias, somewhere around $400, there is a very high chance that price will reject at this level and sell off once again. This would be a sign of weakness, and in that case, price would most likely pull back to touch the middle of the market bias on the weekly chart, which is that $340 to $350 target. And that is why our worst case scenario is that support level. That is where I will look to be loading up with long-term call options, maybe for the next couple of years, setting my first target at $500 and my second target up at $600. From there, we would set a stop loss at a break of about $300, and this would give us a potential 40% to 75% return over the next 6 months, with a worst case of about 10 to 12% if we broke that support level. As I said in yesterday's video, I am not shorting this at all. And in a worst case scenario, if price does not come back up and reject, and instead actually takes out this old high, that's why I have this as our pivot bullish point, then that means price would no longer be making lower highs and instead would begin to make higher highs, showing that the breakout back up to $500 would happen much sooner. Those are the two flight paths that I'm expecting for Tesla, and in the interim, I'm going to do nothing. There's no reason for me to be buying call options here because I think it's just a little bit too early. There's definitely no reason to short because even though price could sell off another 15%, there is no reason to be shorting an uptrending market. Instead, I think that we're just going to see a continued consolidation, much like we saw back here in October, to test the middle of the weekly market bias before that next massive move to the upside. It is actually up 3% today, and I still think that there's a chance that this can move another 5 to 7% before a potential rejection. And in this update, we are going to talk about why I think that there's about a 60% chance that we could reject around 140 and maybe come down to test, worst case, 110 to 105. Now, I want to start by saying that I do not have a short position and I do not have a long position. I'm simply sharing this just as my conviction and what I see. I'm not putting money behind this specific trade. Now, if we start zoomed out on the weekly chart, we're going to be using the market bias indicator, which is this tape-like indicator that you see here. This does a very good job at just dictating trend. And then we use the BX trender, which is the indicator at the bottom of your screen, to show buy-sell pressure. And what we look for is a stock trading over the market bias, and we look for buying pressure indicated on that BX trender. And normally when price pulls back into the market bias, this is an extremely discounted range that we can buy at long term before the continued breakout. And you can see that it doesn't always work. We would have lost back here on the 18th of January, suffering about an 11% loss. But once we're under that weekly market bias and price actually comes back up to test that level, then what we look to do is begin a short position around here, taking profits at lower lows, going short again at the market bias, taking profits at lower lows, and then of course we would have lost here and then started going long again. With all that out of the way, let's look at where we currently are with Nvidia. Well, price actually gapped down with that DeepSeek AI news that came out a couple of weeks ago, and we found a short-term bottom. Now, if we zoom into the daily chart, we've been saying that there's a very good chance that the bottom was in and that we could push our way back up into this resistance level. The reason for that is that the BX trender has actually made a higher low on the daily back on Wednesday the 5th. But as I said before, I don't think that this rally is going to sustain itself up to all-time highs, unfortunately. Instead, what I think is realistic is that this bounce is going to move its way back up to 140 and trap a lot of retail investors. You can see that the weekly chart is actually under the market bias still, and it's red. And in most cases, when that happens, we will move up into that level before a potential rejection, moving our way down to a target of $110 to $103. Now, where do we get that target? It's not arbitrary. If we zoom out to the monthly chart, which is a very, very strong time frame and a very, very big time frame because we only get 12 of these candles per year, you're going to notice that the BX trender is making lower highs and now lower lows. The last time that this happened, price consolidated for multiple months, almost an entire year. And personally, this is just not a market that I would want to be trading. Instead, I want to be trading these massive breakouts with a ton of strength behind them. Now, in this conviction, I hope I'm wrong. And as I said before, I don't feel strong enough in the conviction to take a trade myself. Instead, what I'm going to look to do is if price just breaks out over $152 where this bullish pivot point is, then I will become bullish. I will play this next breakout up to maybe $190 or $200. But if price rejects, I will patiently wait for this to sell back off to 110 or 105, and I will look to build a position down there. Price for MicroStrategy has been compressing since late November and within a bullish trend. And now price is pulling back on the weekly chart within the market bias. And you will see that if we look at the market bias for the past multiple years, anytime we are trending under the market bias, we are within a bearish market. And anytime we are above the market bias, we are within a bullish market. And what we look to do is accumulate around the weekly market bias, since this is a discounted range, and then look to take profits at equal highs or higher highs. The last time that we had this type of setup on MSTR was back here in September, and we played this breakout, which was close to about a 200% move to the upside. Looking at price action recently, you can see that we have been making lower highs, pulling back into this support level of the weekly market bias. Now, even though we are at a discounted level, the BX trender on the weekly chart is still showing lower lows. So if you wanted to wait for a confirmation before the breakout and play this from a safer perspective, you could wait until the BX trender no longer makes lower lows, but instead makes higher lows. This is the indication that the breakout will happen. And when you wait for confirmation, you give yourself a much higher accuracy rating, but you do lower your overall risk versus reward. And so if we're looking at MSTR here and we wanted to enter early, we would look to go long between $310 to $320, setting a stop loss at a close below $270. The most important thing there is that the weekly candle must close under it, not just touch it. From there, we would look at a target at equal highs, which would be $546. And from there, a secondary target to sell the other half of this position at $733. This would give us a downside risk of about 15 to worst case about 18%, with an upside target of 73 to 140%, which gives us a very nice risk versus reward. And this type of play normally works out about 70% of the time if we look in the past. If you wanted to wait for a more safe opportunity, then you would want to see the weekly candle close with higher lows. This means that price would most likely be up about $380, giving you a much higher percent chance at profit since most of those resistances would be taken out, but would actually end up missing out on about 14%. Now, if this stop loss is hit, then we are going to zoom out to the monthly chart to give us an even bigger time frame setup on where we currently are. And you can see that if we zoom out to the monthly and that stop loss is hit, there is a very high chance the price will pull back on the monthly now to meet that market bias. And from where our stop loss is currently seated to the entry on the market bias is about a 40% move to the downside, which is not something that we want to hold. This is why I'm always okay with just taking a short-term loss and having a lower win rate of like 63% to protect my overall downside. It's okay to be wrong about your conviction. It's not okay to bag hold something because you refuse to close a trade. Let's see how this trade sets up, and hopefully we can make some money off of it. If you want to learn more about all of the indicators that you see in this video, as well as the proprietary settings and the step-by-step trading system that I've built, you can take all of our courses completely free with the link in the description.